It is my pleasure to welcome everyone who is here to this very special AMA Fireside Chat with Cheryl Kellond on behalf of the fourth floor. Cheryl has lived through the dot-com bust. She has lived through the Great Recession. She ran a healthcare startup through the pandemic. So basically, she is built for these times. We're so excited to dive into her story and hear all about her journey from the founder and then also the funder perspective, founder turned funder point of view. As I mentioned at the outset, for those of you who are joining us now, please do not be shy with your questions. Put them in the chat, and Cheryl and I will do our best to pay attention to the chat. If you put a capital Q and then a colon, it will help us keep track of the questions. But the point is to bring your questions. Cheryl has answers, so please don't hold back on that front. And then before we dive into the meat of this fireside chat, I do want to say a brief word about the fourth floor. For those of you who don't know what we are all about, the fourth floor is a market network designed to diversify boardrooms and cap tables. We are on a mission to close the gender, power, wealth, and funding gap by advancing for-profit board careers for women and supporting women-led startups that are seeking funding, also supporting women-led funds, and providing women an opportunity to invest in other women. So that was a lot. Said another way, it's a marketplace, it's a community and a marketplace designed to get women onto boards and cap tables. We're hacking the system. We're making it easy for women, especially lawyers, we have a soft spot for them, to initiate and advance for-profit board careers, earn equity, and invest. And we're also helping women-led companies and funds scale. Our board seat exchange is not limited just to women-led companies. It is open to all companies. All companies need diversity on their boards and benefit from that. Right now, there are over 600 active for-profit board opportunities in our board seat exchange today. We just want to make sure everyone understands that. So we want you to join us, and we want you to come search and find those board opportunities for yourself. There's also hundreds of investment opportunities. So if you are not a member, or you know someone who you think might be interested in these opportunities, please consider coming to a platform tour. We do them every Monday at noon. We'll drop the link in the chat. Even if you are a current member, good idea just to come. We have a new platform, great refresher, and just make sure you're maximizing the value. And we have a board bootcamp tomorrow on December 7th from noon to 2. So that is something that we do every 6 weeks at the fourth floor. It is intended for members and not for members. It's intended for founders of companies and also for prospective board advisors and directors. So please consider signing up for our board bootcamp and coming. If you think any of this is of interest, it's a great way to learn what we're all about. Okay, so enough about the fourth floor. Let's get to the point of today, which is Cheryl Kellond. So welcome, Cheryl. And I just want to take a second and make sure that we're both pinned to the spotlight for this fireside chat. I think we might be, even though that's not the view I'm in. And so welcome, Cheryl. Please come join me. Okay, perfect. Now it is great. So Cheryl, you are a two-time founder. You are a 3-time Iron Woman. You are a 4-time mom, which is my favorite fact. And you are repurposing capitalism. So essentially firing up female badassery, and this is how you describe it yourself, LinkedIn profile, which I really appreciate. And also you're starting up again. You're a former CEO of Apostrophe, and your handle on Twitter is XXFounder, in case people want to find you. So that was my very brief introduction of you. Please introduce yourself in much more detail and in your own words.
Oh my gosh. Well, you got all the good stuff. So that's amazing. Hi, I'm Cheryl Kellond. I am Breen, you said it best, right? Like I was around during the dot-com, the Web 1 dot-com crash. So I've been around for a while. I have seen it all. I don't even know what to introduce myself on. I've done it all. I've done big companies. I've done small companies. I've been a founder. I'm an angel investor now. But really, I kicked off the first stage of my career was in Silicon Valley.
Yeah, why don't we do that?
Tell a story, yeah.
Right. Well, and the 5 phases of your life. So
I love this.
just everyone listening, my understanding is that where Cheryl Kellond is concerned, you can sort of neatly divide up her life into 5 phases. There is the early life, there is the Silicon Valley, startup at 40 phase, post-sale phase, and then thought leader phase. So we want to hear about all those phases. Why don't we dive into that first phase and hear a little bit about your early life and also Silicon Valley phase. So, what was going on there? What did you learn there?
Yep. So I was around during the earliest days of the dot-com boom. I graduated from business school at Sloan, MIT, back in '96, right after Netscape went public. I actually sold my first internet startup to AOL in '96 before I graduated. We had this really viral guerrilla style. They called it an e-zine back then, but it's a blog. We sold it, and we got viral all over the country on college campuses and in Silicon Valley. We were featured on NPR. We were one of the first auctions on eBay, actually. We were in the history of eBay book. But AOL purchased us. I made enough money off of that startup to pay for my business school education and pay off all my loans. It was probably the most money I have ever made from a startup. So that will set the tone for maybe the rest of the story.
What you said, now it's called a blog, but it was called something else in the 90s.
Back in the 90s, we used to call them e-zines, like, electronic magazines.
Oh, no way. I don't think I've ever heard that.
Oh, it was back in the day, like the Wayback Machine. You can see us on like suck.com, like that level of back in the day. We hosted our site on the actual eBay servers, because back in the day, my girlfriend that I was doing this blog with shared a cube space with Pierre of eBay fame, and he was running the servers out of his family room, and we hosted our website on his servers, and we were one of the first auctions on his site. So from that really auspicious beginning, right? Like, we're like, hanging out with eBay before it goes public, right? We sold to AOL. John Callahan, founding partner of True Ventures, actually did the deal because he was a summer intern there. And that maybe was a peak moment. Everything else has been a little bumpy and a little bit fun and a little bit less predictable since then. But that is how I got my start. I moved. Yeah, we're gonna say.
I was just gonna say, talk about an iconic time, and also I apologize for the delay because I think there was a bit of a delay. So if I'm interrupting you, apologies. But yeah, wow. I mean, that's amazing. Small world. Just what you described there, and really, when you think of dot-com and you think of Silicon Valley in the beginning of it all, like you just summed it up. What about? I know we talked about your concept to launch product career. Yep. So maybe I think maybe it would be interesting to hear about like major takeaways from that period. Like, how did they influence then the path that you took?
Yep. So I built my early career in Silicon Valley, went out there right after business school, and took a series of product jobs. I don't think I stayed anywhere longer than a year and a half, because the market was so fluid back then. And along the way, what I learned I was really good at was 0 to 1. Concept to launch on the product side. And I did just about everything. I did laptop computers at NEC. I went to E-Trade and launched their content and community site. Did a bunch of the site that ended up powering TurboTax Live Advice, so a live advice site back in the day when we were worried about people putting credit cards on the internet. And we're like, should we ask for their social security number instead? Crazy early stuff. But I quickly figured out about myself, I loved concept to launch. Like, by the time it came time to version 2 and a management structure and reporting, that sort of wasn't my jam anymore. It was fun because I moved in and out of between small companies and big companies, right? Because I told you I had NEC in there, which was a bigger company. E-Trade was small at the time. I did a stint at Yahoo, which was a bigger company. I did a whole bunch of startups that no one will remember. I mapped that ebb and flow. If you look back on it, I don't know if I was conscious of it at the time, but I mapped that ebb and flow to having my kids. Right. So I landed in Silicon Valley right after business school, and I had a kid already. And then I had 3 more over the course of the next, I don't know, 8 years. And those were back in the day where Silicon Valley startups didn't offer maternity leave.
Oh, right.
And it was a giant exception. And wait a minute, you're going to be out for 3 weeks. No one else gets to be out for 3 weeks. I mean, meanwhile, I'm having a baby, and 3 weeks was the amount of time in question, maybe 4 if I hadn't taken vacation all year. So it was this really sort of weird, ugly time. So I became a fluid person. Over the course of those years, I did probably about, I don't know, $750 million of version 1 product launches, which was super fun. And I can do everything from hardware to ad products because it's the same motion, the same way of thinking, the same way of getting into users' mind. So it was a hoot.
A hoot sounds like definitely one way to describe it. And but also, I mean, just incredible, right? To be there for so many of these launch stories. So I imagine, so those experiences that you're having, I love that the next phase is founding a startup at 40. When you told me that, I loved it for so many reasons. I personally love this because it's, you know, aligns with my own journey. Now, I remember reading that the absolute perfect age to found a startup in terms of the likelihood of success for that startup is 40, because you have all of the requisite kind of life experience, you have the maturity, you have the, you know, the endurance, right? The resilience that to, if you have to, like, you know, really suffer for a long time, and you still have energy. Now, I know there are some downsides to founding a 40, but love to talk about like what made you actually then take that leap to become a founder yourself, and how much of it, what was it, that product to launch experience that you were having?
It was a combination of that's the phase I loved and was really good at. And one day I woke up and had a problem I cared about that much, right? Like when you do a startup, that the thing you're focused on, not the solution, but the product and the customers. This is something I learned later and we'll talk about later, but the problem and your customers has to feel like another child to you because you're going to spend that kind of time with it. And I didn't actually wake up one morning. It was after a number of glasses of wine with some friends. And we were like, hey, these sports watches we're using. I was a triathlete, right? That was my stress relief. And so we were training a lot and we had all the gear. And so after a few too many drinks, we were like, hey, these sports watches sort of suck. They're too big, they're too heavy, they hurt our wrists, they're hard to use. I bet we can make something better. And then I had built up enough of a network, I can make a few little calls, and all of a sudden I had a girlfriend who tried some connected jewelry, and she knew this team at Nike who had built their sports watch, and they were rolling off the team. And all of a sudden I was like, yeah, totally. I can build consumer electronics from scratch and compete with Nike and Garmin. Of course I could. And so that was my first company. So I did, I know. And it was at this moment in time, and I don't know who will remember this and who won't, but there was a moment in time back like in like the 11s, like, so not the teens yet, but not the aughts, that funny 2 years there, the 11s and 12s, where like Pebble had come out on Kickstarter, and crowdfunding was the way to fund early stage hardware because you could get all of these early orders. And then once you had all those early orders, VC would throw money in.
Right.
That notion lasted for about, like, the tail on it was like a year, but it really only worked for about 6 months. And the notion that you could build consumer electronics from what you raised on crowdfunding was also not actually correct. But we had this great idea and we had this brilliant design. And so like, we're going to go on Kickstarter and we're going to get all these orders, and then we're going to raise the rest of the money to build consumer electronics with that venture money. Right. We had an incredibly successful Kickstarter. It was the most painful 30 days of my life. At the end of the day, we ended up raising over $400,000. $400,000 was our goal. We went from 300,000 to 400,000 on the very last day.
Wow.
It was the most amazing community generated mobilization. So it taught me deeply about the power of building a community and activating them against your cause. It was super exciting. What I was left with was $400,000, and I needed to deliver a full-fledged consumer electronics products with it, which was tricky. We did it. I had some great partners. I had attracted the attention of the group that launched the park bracelets for Disney World. So they were super experienced manufacturing and design firm, and they took me on an equity basis. We ended up shipping that product after 2 long years of detailed updates to a multi-thousand user backer base. And all the pain that came along with that. We did end up shipping. We were the top rated product on Amazon, but it was amazing. Turns out though, you can't really sustain and grow a hardware product on shoestring money. And after our Kickstarter, obviously we raised more money. I raised probably about $1.5 million from angels and small funds. Never got any big fund money, got close, but it was always the, hey, really interested in this? Can you let the woman at the front desk try it out for the weekend to see if there's really a market for it? Can I take one home to try for my wife so she could tell me if there's really a market for it? Because it was a product designed to fit women and designed for women's needs, right? There was a safety feature on it. It had a slim design. It was cute colors. So there was this huge gap. They loved it, but they just couldn't get over the edge with it. Because they didn't understand that women were not maybe a niche market.
Right. Well,
right.
And I think like the world doesn't understand that.
They haven't figured that. Yeah, we haven't figured that out
so
for
many-
healthcare yet. That we're not a niche market, right?
No, it's femtech. It's not.
Yeah, exactly.
It's women's health, right?
Not half the world health.
Yeah. Okay.
Amazing.
So I know now you have this company, and then you don't stop there. So then you found a fintech company. But so all these lessons that you learned about this, that you've just done such a great job identifying some of them, very interesting. The one we land on is, this problem that frankly so many female founders have, certainly products that are geared towards women have. But then why did you pivot to fintech? Like, were you trying to get away from that bias or those problems?
Yeah, so this was, it wasn't the same company that pivoted, right? We eventually had this moment that, I was burned out. My team was working, for free, essentially. We were, again, #1 rated on Amazon. They were stocking our stuff, but we just didn't have the capital to get more efficient and get over that hump. And I woke up one morning and I was like, hey, you know what? I also sort of get it, right? Like a guy wouldn't have gotten to put in the niche market bucket, but was I building, was this a $1 billion business? Venture requires a $1 billion business. Is this a multi-trillion-dollar market? And I woke up one morning and I was like, and also, is this problem the best use of the time and talents of my team? Like, I know the transformative power of sport, but do I want to spend the rest of my life making a watch? And so we decided to shut it down. We had delivered everything we said we were going to deliver. We gracefully exited. I took a 6-month sabbatical, trained for my second Ironman. Took kids out to ice cream for dinner every night.
Ironman? Can you just remind for people who don't know, like, what does that entail?
It is a 140.6 mile multi-sport race where you swim, you bike, and you run.
Oh my God.
You have 17 hours to do it. You can take as much of those 17 hours as you want, and they give you free food the whole time. There's people out there with signs and cheering. No one can ask you for anything. No one can call you on your phone. No one can text you, and they feed you. It's amazing. I think everyone should do it.
Okay, spoken by a mom of 4 kids. I'm just and
so,
right.
Amazing.
My 2 kids turned me into a runner for a while. So, but never to that.
You get it. But so yeah, my next company was in the healthcare fintech space. And it was the same thing. Like, the problem came to me. I was doing this bunch of reading and I read this amazing case study of a hotel chain in Florida who did something really creative with their health benefits. And they made their employees who were, they made their employees healthier, and the employee retention went up, and they saved so much money in the process that they started investing their savings and building free preschools in the neighborhood their employees lived in. And I was like, well, that's really a worthwhile thing to do. It's super interesting. I want to build that into a SaaS platform so any employer can do that. So that's what we did. actually. We were a Techstars company. I had a co-founder who had run a health insurance company. And we got that off the ground. We grew it. I raised about $17 million of venture money through a pre-seed, a seed, and a Series A. We got to 10 million in ARR after selling in the market for 2 years. So we grew it really rapidly.
Wow.
I learned a few things along the way in that journey. First of all, while I loved the problem, turns out my customers were not the members whose lives we were benefiting. And our members were fantastic, right? We had the largest non-union family-owned steel mill in the United States. We had school districts throughout Michigan. We had, just a lot of industrial Midwest blue and gray collar companies that really needed their benefits to do more from them, and they needed to keep more money in their employees' pockets. So that part of my customer base was amazing. The folks I sold to every day were like mid-level HR managers and benefits brokers. And they had a different set of interests. And sometimes my program was fighting against those interests, and I didn't love those interests, and I didn't love them as customers. So that was one of the things I learned.
That's so interesting. I mean, I think the misaligned incentives and just, if the person you're selling to is not the person that's ultimately getting the benefit, like there's, I don't know, it's very interesting. And I think there's probably a lot of business models that can, find themselves in that space. So what did you do when you discovered this?
Well, that's I was still in charge of running this business then. But that's what I tell founders now. I'm like, it's not enough to fall in love with the problem. Make sure you love your customer. And I think that's more important than loving the problem. So that was, what else did we see there? The other thing I learned is there's a thing about founder like business fit. Like I told you, I raised almost 20 million of VC. I don't necessarily love VC. I get the job the capital is supposed to do. But that's not in the best interest of every business to grow that way.
Right.
And while I had this incredible laser focus on unit economics and getting to break even, there were things we learned about the business once we were into it that sort of moved our break even number higher than I thought it was. So I was hoping to get to break even earlier, and then we would have a few more things in our control. And I ended up in a world where I had to raise more VC than I wanted to. And I started to I had a whole set of issues, which are too long and complex for this call. But I ended up being in a position that I needed to do my Series A raise in Q2 of 2020. Okay. Like kicking off a raise from scratch the first week of March, 2 weeks before the world shut down with the pandemic. And that was super frustrating and super hard. But along this way, as we were building the company, there were sort of two other companies in the same space with us, started around the same time. My company had faster growth, better unit margins, more customers. And I was able to raise substantially less money than my counterparts. And I would put on gender. In fact, we had an investor that wanted to roll us and this other competitive company together, and they wanted my company on top. And the other company's investor said no to it. And there was a founder with a little bug in his head for a while. So I saw front and center the gender problem there. Like it was so clear and so obvious, and everyone on my team saw it. And it makes you feel crappy as a founder. My team needed me to deliver something to them. And no matter how good we were, no matter how good I was, no matter how hard we worked, there was going to be less. And so when the pandemic struck, no surprise to anyone, HR departments don't switch their benefit plans in the middle of a pandemic. Like you just don't. So we went from like 300% year over year growth to like flatline. And in fact, I was firing I had a few customers that weren't profitable, and I had to fire them, right? They were sucking more money than they were bringing back. So it was really rough. we were going to come out of it strong, but there was an opportunity. We had an opportunity to sell to that competitor that we tried to get rolled together with for. And since he had a big war chest and I did not, head of my board decided that they wanted to do the acquisition. So he then turned around and raised $50 million off of my lives on his books. So I feel like we must have built something valuable there. Someone else raised a lot of money from it, but it was definitely a special experience.
Oh my God. I mean, really, like, okay, so have to ask, like, and I remember when you told me this story, when I first heard it, I feel like it was a year ago or so, it gave me goosebumps, like just all over my body. And I want to make sure, you double down a little bit on it and everyone really heard you because it's just so striking. I mean, it's just so clear what you experienced. Yep. Have you been able to get it out there? I mean, no, I know we're going to get to your other phases, your post-sale phase and your thought leader phase, where we're going to talk about how this lit a fire under your ass. But like, what could you do in that post-sale, in the middle of that? Like, was there anything you could do? Were you writing op-ed letters to the New York Times? Like, were you trying to get that story out there?
No, because ultimately, what good is that going to do? I become a whining, complaining female. Was it really because of my gender? Or was it really something else? And what changes because of it? Nothing. Like, I don't believe that you actually can fix the system from within the system anymore. You just gotta build a whole new one to the side. Which is a little like where I'm going next. But I mean, I'm one to focus on positivity and what positive actions I can take and not to dwell on the past, because what good is that going to do? It's not like I went into the structure naive, right? I knew the system I was playing in. I knew what they needed to see. I knew that no matter what I delivered, it was going to work a little bit differently. So we did the best we could, but we knew the game we were playing. I was like never naive about that game. So I also didn't have a right to complain.
Well, right. And it's, it's one thing to not be naive. It's another thing to actually find yourself when you've, all the blood, sweat, and tears, you have a team playing on you. And then to find yourself in that situation where you don't have the war chest, where you don't have the leverage, where something you're being assessed, you're two equivalent, but somehow you're less valuable. And it's not clear why, and then to really have that just salt in the wound of immediedely, that the company you built actually raising $50 million of venture money when it's a man asking the question it's another thing to actually experience that. And then to be so motivated to now fix that problem, because that's a really big problem.
What are you going to do except go fix that problem and make sure, everyone else sort of learns from my journey. So maybe they can carve a different path and help them carve a path that's going to work or,
Right. And of course,
I don't know, what are you going to do?
No one has bad intentions there, right? Like on the one hand, what good does it do, right? It doesn't help to wallow or to complain. Also, no one has bad intentions. No one's doing that intentionally. No one believes they're doing that. It's that's why it's so insidious and so difficult. Because
it
no one's
totally is.
That you just have to rebuild or build a new playground. I love that.
Yeah. Okay. Let's be clear. I paid for a high-priced coach and therapist to help me work it out of myself after it was over, right? Like I was like, oh my God, this thing keeps creeping up and like devouring me because I'm so angry. Like, I'm also, just if we're talking frankly, I am a really great day drinker, and my fantasy career is to play air tambourine in a bar band. So I spent a lot of time doing that. So, good, there's a band around the corner at 2 PM. I'm gonna go play air tambourine in the corner and have a few drinks. That's amazing. So I had a lot of forms of therapy to get through it, but it was not easy. It took a while.
No, I believe it. But also anger is not necessarily bad, right? I mean, like, feeling frustrated and coming up smack against challenges, inherent things that are broken, you're a fixer, right? You want to build, you're really good at zero to launch. So how do you react to that? So I guess like now, since we're in your post-sale phase, I think this is the phase of your life where you really started to identify as an investor, right? And I think that probably has something to do with everything we're just talking about here, because you've just come up, you've just seen, yourself these problems in the venture world, in the private equity world, and when in the status quo. So can you speak a little bit about that evolution? I guess going from the band, day thinking in a band, to like, okay, how do I evolve? How am I now full circle?
Yep. No, that's a great question. And I want to put it a little bit in context because there's a bunch of things going on, right? My early career and my switching jobs and like developing a skill as a concept to launch expert was partially a byproduct of I was having kids. And every, 2 years, I'd have to take a little bit of time off to drop a baby and be at home for a little bit, whatever, there was an ebb and flow that happened there and I built my skills around it. So after I sold my company, I'm turning 50. So there's 50-year-old changes. I'm entering the no fucks to give years. I'm starting to empty nest. I have one kid left at home now. And so, and thinking about what the back half of my career looked like, what kind of flexibility did I want there? What kind of lifestyle did I want? What was going to be meaningful to me? Did I want to hook myself to one thing? I mean, what if I started something new and I ended up with benefit brokers as customers again, because I was, make the same mistake twice or something. So I started to think more holistically about what I wanted to do. And I also felt this need while I was running my company. I wasn't very active in the startup community. I had my own little chickens and my own little stuff to take care of, right? So I wanted to give back, right? I'm in a Techstars town. We give first. So I wanted to like cram a whole bunch of giving first in so I could extract some good karma later when I figured it out what I wanted to do next. So I took a gig EIRing for a new Techstars pre-accelerator program called Founder Catalyst. We get 20 female founded companies every quarter in a different, usually second tier startup city in the US. So I did a ton of mentoring. I did the thing that I would recommend every startup founder does. I became an angel investor. I joined Angel Squad from Hustle Fund. And it's been an amazing experience because between Techstars and Angel Fund, I've seen so many deals and I've seen so many decks and I've seen so many pitches. And so I developed a muscle memory, both that helps me as a mentor, but is going to help me again as a founder. Because now I was like, oh, that's what earned insight feels like when you get that aha moment and something that no one else knows. Oh, this is what market pull feels like. So you can't delude yourself as a founder, like, oh, maybe I found PMF. Maybe I didn't. I got product market fit now. Yeah, no, when you have it, like you feel it, you can't hold on to the thing. And because I've seen that in other companies now that have pitched to us in Angel Squad. So I will make that commercial. Anyone that is a founder, even if you can't write checks, become part of an angel group and see the deal flow and see what that feels like and see what that sounds like, because it will make you better as a founder in terms of what to expect.
I love that piece of advice. We love that piece of advice. This is a lot of why our investment club is structured the way it's structured. It is extremely inexpensive, and anyone could join that is an accredited investor. You don't have to make any investments. You don't have to do that. The whole purpose of it is yes, of course, to invest if you want to, but to learn and to see it, into the other side, to understand that it is fluid and that it's holistic, and that the founder story and the investor story, that they should have aligned incentives. They should want the same thing. They're just speaking a different language, and they're a lot of times, using different reference points, and so there creates all this noise that if you can eliminate that, it's incredibly helpful. So I love what you're saying, and I think other angel groups and communities are figuring that out as well. So great piece of it.
So the third thing I did in this time of figuring out where I was going to go next is I got super deep into Web3, right? Remember, I'm a Kickstarter founder. This notion of community capital and the vibes, I love that. Like, that's who I am. This feels like the democratization of wealth and just the ability to think in fractional ways, and to think in community ways, and to think in ownership ways, and just the general the surprise and delight that sometimes exists in the space. And I don't mean surprise and delight, the curly haired kid ran off with all my money, but just like the surprise and delight of, you know what, let's put a JPEG on it because it's sort of fun. That totally sucked me in. And because I'm a founder, I'm a learn by doer. So I've done everything, I've DeFi'd, I've hardware walleted, I've minted, all the bits and parts of Web3. I got my hands dirty with it. And I ended up leading a 6-month Web3 accelerator over the summer, which got me super deep in the space, gave me a little legitimacy, I guess. But seat me in both the ethos and the technology, which is important for where I'm going next. So I think I was just open to the possibilities of exploring. I picked a few things that I loved and made me feel good as I tried to pull them together into what's next. Because I am not, you heard about my sale, I'm not necessarily post-economic. There needs to be a what's next.
Right.
Those kids still require money.
Right. And there needs to be a what next too for all of us, because now, this is quite a journey. So you come full circle, right? You kind of finish this evolution of now you have the investor perspective, but then, this is what I told you we should call the thought leader phase, right? So now you can give back that way too. So definitely good for all of us if you have a what's next. But then let's talk a little bit more about that. So like I think we would all love to hear, like, okay, you've told us a little bit about why Web3, but now what are you doing with Web3? And then how does this get to, and I'm just very curious, I personally hear all about this. Why do we collectively and individually need to rethink early stage capital? So, you had all those experiences we just heard about that you told us about, and you came up against the wall and saw all the ways the system is broken. So now, how does this make you go to, we need to rethink early stage capital? And how does this relate to Web3?
Yeah. So, gosh, where do I even start with that? I always had trouble with the way early stage capital was designed because it was that I've always had an issue that the only kind of capital easily available to founders is VC capital, right? It's what's promoted, it's what's easiest to access. In some ways, it's what we're told. We are brought up in the startup space to believe it has some intrinsic signaling value of our goodness as a founder. We've let it get in our heads. But that capital has a job to do. There is math that it needs to meet. It is a product for a purpose. And not every company needs to be up and through the moon. And actually, most are not. And what I had seen is I've got a number of girlfriends with companies that raised early venture capital. They didn't go up into the moon, but they built really great businesses that were providing for their employees and for them. And they were growing, and this was a great business. No one wanted to sell it. No one wanted to get rid of it because it wasn't going to meet the needs of the capital anyways, right? If you're not up until the moon, they don't care because that's not the job they have been hired to do. So there feels like there's sort of a gap in the middle. We filled some of it with crowdfunding, but that has a stigma on it. Indie VC ran the most exciting experiment out there. And we may see some of that come back. But again, if you're raising from institutional money to fund one of those kinds of experiments, there's not a fit for it. And increasingly, as funds got bigger, they're forced to stuff more money into companies and make beautiful things screw up because you're trying to get it to grow too fast. And I'll be really clear. I'm sort of a little bit of a socialist and an anti-capitalist in the most capitalistic way. So whatever, I'll talk about the extractive capitalists all day and be the crazy woman playing air tambourine at the bar, going off about when Jack Welch ruined it all. But there's a gap there, and it exists more so for female founders, and we all know that. Well, if you look at angel capital has the ability to fill some of that gap. However, right now, angel capital is like a bad afterthought of VC. It's increasingly important to get founders started. But the only way we've instantiated angel capital is to tie it to VC exit metrics and VC exit timeframes. And institutional money needs those power law returns. Well, guess what? I've talked to 100 angel investors, would-be angel investors, head of angel groups. And people like you and me actually don't need power law returns. In fact, part of it for angel investing is financial returns, but there's a big part that's not about just financial returns. It's about who you're helping get started, what problems you want to see solved, who needs to get the chance at being an entrepreneur because they're going to do something great one day. We can't do that if angel capital is only tied to VC. And then as we were doing our own angel investing and looking at the math and building our own spreadsheets, we did a deep dive into the numbers. And they're interesting once you start to look at the numbers. It's a power law game, right? The way it's set up now, you have to make a lot of bets. Most angel investors can't make a lot of bets. We can make like 5 bets or 8 bets a year, even if we're writing really small checks. And if you make 50 bets a year, guess what? You are going to have better than market returns. You are going to perform like a top, 40% fund manager. But any less than that, it's hit or miss. So there's a math game with it. There's a misaligned, between the individual angel and the VC fund. And the math isn't stacked in our favor. So in terms of what I'm doing next, I'm trying to solve a few of those problems. We started with the prompt, what if we made angel capital work the way founders and funders want it to work? And then we talked to scores and scores and scores of them and tried to understand what they were getting out of it. And then we looked at the math and we looked at, what is going to make this a sustainable regenerative asset class for each individual angel? Because an angel, I don't want my money tied up for 15 years. I want that money in motion to help the next new founder and the next new founder and the next new founder. How can we structure that so I always have new checks to write? So that's what we're messing around with right now.
Oh my gosh,
so much math.
Okay, so just so I understand what you're saying, so you're messing around with it. You're going to get the math right, and then when you do get the math right, you're democratizing angel investment, you're streamlining it, you're democratizing it, and it's a turnkey solution. Like it's not what exists right now, like an SPV. It's not within one of the vehicles that people are using today. But
what about use some of that back end, but there's a different wrapper on it and a different flow to it. That makes it do different things. So,
and what about the regulations? So I know this is maybe a little off scope of what we were talking about, but I'm very curious as a lawyer. But not a securities lawyer, so it's not my area of expertise. I know what I don't know, but what I do know is that it can be thorny. I also know that there's change, but like, how are you? Does that factor largely to what you were trying to do?
Yes, to make it has to make what we want to do possible. Just so you guys all know, I am getting my Series 65 and studying for my Series 7 now. So I know as deep as anyone does. I dream about QSBS at night. So we are deep in the regs. We're working with a really forward-thinking fund lawyer. We are working with folks that are deep in the Colorado co-op space. Colorado has some interesting co-op laws that allow some interesting things to happen. And then we're running a lot of math and trying to do something different with how we structure those flow of funds to give returns in a different way and keep that money in motion. So we are pushing on the limits of everything. We see a path through. We've got to just lock all the pieces in. But at the same time, we're a startup. So we're like, okay, what is our minimal viable test? What are we doing in market now? So like we did a dumb little NFT drop just so we could start showing some vibes and getting edgy. We are bringing back, Tuesday night pitch practice on Twitter after the first of the year. So we're doing all those baby steps to build community and get a voice and put some of the knowledge out there. But we're taking an edgy kind of, not fully Web3 approach, but we can make it fun, right? Finance needs foreplay. Let's have a little fun with it.
Oh my God, so do board seats.
Right?
We built the board seat exchange that we did. So
exactly.
Real emphasis on fun. Those are the pre-advisory board opportunities. I love that. Okay, so there's a question in the chat. I mean, I believe it's a question from O. Hi, O. She's asking about
cannabis co-op? No, Colorado co-op. Colorado has a different kind of co-op law that allows for different things to happen, and it's different than all the other states. I'm not building a cannabis co-op to help us angel invest, and we won't even notice the SEC rules.
Right.
I
That would
dream
be
about QSBS
oh
and
my gosh,
Technicolor.
the way around the regulatory bumps in the road. I love it.
I
Okay.
mean, I'm Colorado, right? Pot and shrooms.
With
We
your
can do it all
cannabis.
here.
So like, yeah. Okay, so not cannabis, but co-op. Very interesting.
Yep.
I wrote that down. I'll be nerding out on that later to
Yep.
try and sniff around what you're doing. But curious, like, and I don't know if I'm just imagining this might be a question people have, thinking of like angels list and thinking of, the people that are out there today trying to create alternative fund structures and try and democratize the existing system. They're trying to tweak and evolve like the existing system within the rules. It doesn't, I don't know where it's going, but like, how do you think that? And are they looking at Web3, or are you taking a totally different approach? Like, are you totally rebuilding the ecosystem somewhere else using Web3? Like, I don't know.
I do not. It's so funny. Someone asked me a question. They're like, so are you looking to replace Angel List? I was like, oh, hell no. That's someone else's job to do. I don't need to replumb like K1 tax forms. That's not where I'm going to live and thrive. We want to build on top of that. But what essentially we're looking at doing is, first of all, putting some vibes and a way to engage in the ecosystem that's really friendly. But then think about if you could run an index fund with small monthly investments, double down on what you love, and instead of having your money locked up for 10 years, we exited positions at, I don't know, Series A, maybe, first equity round, right? Because you want money in motion. And if you look at the math, you will always return a better than market investment, a better than public market investment, and significantly better if you spread your bets out. That is actually the best way to play as an angel. But as angels, there's companies we love and there's founders we want to champion. So we're looking at how we combine the best of both those things. These are the founders I'm ride or die for, but sort of spread the rest of my money out there so I can be regenerative. So that's a piece of it. And we're looking at if you've got a bunch of investors that don't need actual power law returns, do you know when the greatest ramp in return is for most companies? Between first check and Series A. I'm just going to leave it there. Interesting. What would you do with that information if you had it? So where Web3 comes in is any of the stuff we want to do on top of existing platforms needs blockchain technology to do some of the accounting and allocation. And Web3 comes in because of vibes. Like, let's make this feel fun. Let's make it feel great. Let's not make it feel like investing.
Right. But the blockchain piece, I think that's an excellent point as well. Maybe sorry about my throat. I see a question. Is it like dividend reinvestment? I'm not sure about that.
A little bit, yeah. Yeah, that's a good way to think about it.
Good job.
A little more SEC law jiu-jitsu going on there, but yes,
okay.
It's a good way to think about it.
Okay. And then blockchain. So blockchain, is that part of, blockchain buzzword, obviously, but, popping up now in so many different industries. Do you think the future, like if we're just talking about venture in general, like what's happening in venture right now, are they tapping into Web3 and blockchain? Is that part of their buzzwords as well? Or is this a unique direction?
No, I don't think this is a unique direction. I mean, I suspect AngelList is rebuilding a whole bunch of their stuff using blockchain technology. Syndicate.io, Will Papper's company, is looking to unseat Carta and AngelList, and they're building all on top of blockchain technology. It lets you do things more granularly, more transparently, more fluidly, more efficiently, more scalably. So it's a tool to meet the purpose, not the purpose.
Now, okay, another question, because maybe there are other players out there thinking about these alternative approaches. Do you, part of your thesis, is part of what's baked into that, leveraging underrepresented founders? Because especially given your experience. Okay, I would imagine. Of
course. Yeah, no, I mean, you know what? It's where the alpha exists in the market, actually. right? Like we actually usually, it's where there's lower valuations and bigger need for capital at the early stage. It's where you get the better markups as you go to Series A because you bought in earlier. There's an amazing range of emerging fund managers, identifying those opportunities out there, and angel groups identifying those opportunities. All of those angel groups and all of those emerging fund managers could always use an extra check for their folks, and could use an extra check of really nicely networked people that are going to amplify their companies in the early days of selling, right? Like early stage company, they need to sell. Who's going to help amplify?
And also part of this theory is that it would not be necessary to only target the future unicorns that venture is going to be piling on. It could, there's the ability to leverage other types of companies that are zebras.
Totally. Exactly. Because you're not playing that long-term game. That's a great thing to point out. And that is true. We just need a really healthy vetting mechanism for them, right? I mean, I've worked with 100 startups this year, 108 actually. And like, now I'm starting to see it. I'm like, oh yeah, every group, there's a few you're like these, a few that you're like, and a few are like, she's going to get it on her second at bat. The second at bat's going to be the one. So that we want an efficient vetting mechanism in there as well. So, but yeah, it gives us a lot more flexibility. We're just trying to find the right place to start. But it really started with being able to look at the math from a natively sort of angel investor point of view and what you needed that capital to do for you, both financially and in Web3, there's this notion of like 8 different flavors of wealth: knowledge wealth, social wealth, community wealth, connection wealth, environmental wealth. And thinking about, if you talk to an angel, they want more than financial wealth out of that. So let's develop a product that meets the other forms of wealth as well.
Right. Well, it's very interesting.
So
very
early stages. Thank you for letting me talk about it. I wish I could be more concrete, but we are truly like in the middle of weeding through and figuring out which place we start from. I think the only, the good news is we see a path. Just figuring out the right one without going to cannabis co-op jail or wherever we're going to go.
in deep in Colorado. So. No, really exciting. And just to hear your whole journey, all the phases of life. I mean, it's not all phases of life, but the phases of an entrepreneur is a better way to say it. To hear you getting started and then going through this journey a couple of times and all the things you learned, and then kind of going full circle, seeing it from the other perspective, and now you're doing it again, which is, someone said in the chat, very inspiring. Totally agree. It is inspiring. Also it's exciting because it's just a fight worth fighting. Like all of,
it's gotta be, right? There's not many of us that have known it and been through it, right? I am certainly not the most successful. I am certainly not the most, famous or well-renowned. I'm not even the best connected, but I am one of a finite group of people that has been through the whole journey. So I have something to bring that no one else can bring, and it's worth fighting. Like, what am I going to do for the back half of my career? It's got to be worth doing. So you got to pay it. You got to pay it back and pay it forward. So.
All right, exactly. Okay, and since we are, this hour just flew by. For those of you that dropped a couple of questions in the chat, I hope, if I missed, I don't think I missed any questions. I saw a lot of comments. I didn't really see any other questions than the ones I asked you.
There's any questions, people ask now. The one question we didn't get to directly was, I bet we probably answered it, was Sarah's question about how to remain your true self while also trying to mold yourself to corporate culture. I think you all got a pretty good sense of what I say to corporate culture.
Well, now's the decade where you can say it.
Yep, exactly. So, but no, if there's any questions, I'd love to answer them and see them. And or just wrap up.
And you know what, if there are any, for those of you that are part of the 4th floor, you can find Cheryl, of course, in our platform. Please do not hesitate to ask her a question. Reach out that way, reach out other ways. And oh wait, no, there is one again. Have you heard of Orange DAO?
Yes, I love the guys at Orange DAO. They did a few things with my cohort at Angel Labs. Know them well.
Awesome.
Know them well. They're doing something a little bit different. They're running a traditional fund with traditional LPs and wrapping a little bit of DAO around it. Chain Forest is another organizations sort of doing something similar to Orange DAO. My thing is playmoneystudios.xyz. You'll absolutely not understand what we're doing by looking at the site, but we're going to start putting updates there, and we're going to start making baby steps forward too. And that's the place to go to get the up-to-date news of when Tuesday night pitch practice is coming back. It's amazing to listen to as a funder. It's amazing to be part of as a founder.
Yeah, no, very cool. That's really great. And we'll talk about ways we can, help augment that. And thank you everyone coming today to this session. And just thank you, Cheryl, so much.